The biggest issue driving the prices of financial assets locally and of course also globally is people's and particularly investors' perception about risks. Given the very uncertain macroeconomic environment, people are prepared to pay up for certainty. On the other hand, where assets produce a very uncertain earnings stream or profit stream into the future, investors are generally not prepared to pay for those assets. And the South African market is very interesting because as a result of these perceptions, there's a huge valuation gap between those shares that generally produce a very steady income stream versus those shares that are arguably quality counters but that produce an income stream that is more volatile over time. It is very easy to categorize shares in South Africa. Typical non-cyclical shares, or what we call defensive shares, are shares like British American Tobacco, South African breweries, Tiger Brands and Shoprite. You would agree with me, all these shares represent great quality. On the other hand, you get quality shares, but however they produce the earnings stream in a very cyclical fashion. Shares like Impala Platinum, JD Group, Astral, all those shares represent a lot of uncertainty in terms of the future earnings stream. Those shares, however, are quite cheap. Within the SPI portfolios, we have certainly favored the non-cyclical or safe shares. And our clients have reaped the benefit of our performance as a result of that particular positioning. However, we think that the valuation gap is certainly just too big at the moment. And over the last 18 months, we've tilted the portfolio where we've included more of these more cyclical shares at arguably very cheap prices. Although people find comfort over the short term with the safe shares, we believe that value ultimately will dictate investment performance, and to buy great, even cyclical shares at cheap valuations, we think will reward our clients over the longer term.